Um, as you know, the treasurer reports monthly revenue collections publicly, and so does OLS. We use somewhat different methodologies. The administration presents their primary revenue table is a number that they call earned, which is actual cash collection with some adjustment to it. And frankly, I can't explain that adjustment, and at some point you might ask the treasurer to explain that, but we don't know exactly how that works. But they measured that against budgeted, which is their assumption for each of these major taxes for each month of the year. We present in our revenue reports cash collections compared to cash collections in the prior year. And then we note as well what the expectation is for the end of the year. We have internally for the major taxes our own monthly targets, but we don't report those and we don't publicly discuss those. In terms of the income tax for this year, both Treasury and OLS anticipates that collections will be down because of the expiration of the so-called millionaire's tax. The surcharge that was in place for 1 year will result in a decline in our collections, even if the underlying base of the income tax, that is, earned income, might be going up. We expect revenues to come down because of the elimination of that high-end rate. The administration appears to have applied that reduction to each of their monthly targets. When we did our monthly targets, we didn't do that. Most of the income that's taxed at that highest rate is not subject to withholding. It's not coming in people's paychecks. It's coming in business income, capital gains, and so forth, on which there is no withholding, which doesn't come in smoothly over the 12 months. And we anticipated that most of that impact would occur in April and May, and some of it in December and January on the fourth estimated payment. Okay. Why does that matter? When we look at revenues, income tax revenues, for the first 6 months of the year, we see that collections are down about 1% from where they were last year, which is about what we expected at this point. The administration's calculation shows the income tax revenue under their methodology being up 11% for the first 6 months. That is 11% above what they had budgeted, what they had anticipated.
That's a major difference, though.
It's a major difference. It's a significant difference if the administration thinks that that 11% is meaningful. I mean, if when the governor comes in later this month and does his revenue revisions for the current year, if they think the income tax is going to be up 11%, then that would be concerning. I don't think that's what the underlying data suggests. I have no indication that that's what they're going to come in and say. I mean, I think they probably understand this. I think that this may be a function of targets that were established last June and perhaps were not thought through as fully as they might have been. I don't see any indication from the press release that they're opening champagne bottles to celebrate the income tax. We'll see. But that's the basis of the difference.
And Dr. Rosen, yours is based then on actual collections, cash on hand that has come in. Is that correct?
Right. What we report is cash for the first 6 months of this fiscal year versus cash for the first 6 months of last year.
That's been collected.
That's correct.
Okay. And we have, since I've been chairing this committee over the last 10 years, we've tried to take that very conservative approach because there was the 1 year where the estimates were so grossly exaggerated that it created a tremendous hole, which is, quite frankly, the year where we walked into the $9 billion deficit, where, for instance, corporate business tax revenue So in order to avoid a repeat of that history, we have taken a very transparent approach, which has been a very conservative approach, which over the course of the 10 years that I have done this, one of the things that I have always cautioned the administration side and every treasurer that has sat here is that your numbers have always been within a half of a percentage point of every treasurer, including the last one, in the estimates that have come through. This would be a major variation from that previous approach, which I think would lead to what could be a very damaging budget process as we move forward. And that difference is, you would, if my understanding is correct from the information, that your targets would indicate that we are about $50 million above projections. If the treasurer has that at a little over 11%, that's $450 million. That's a difference of $400 million. That's a significant difference. Is that accurate?
As I said, if the treasurer ends up revising upward their estimate for this year, assuming that the 11% is real growth above expectation, then there would be a significant difference.
If he estimates...
But we haven't seen that yet. This is simply the report on collections through January.
Yeah, and Dr. Rosen, I don't want to rub salt in the wounds, but that's why we asked him to be here today. Because they were very anxious last year to be here to talk about, how they were going to close out the existing fiscal year. They came in at this same time. And I think it's critical so that we don't see a repeat of rating surplus accounts from school districts to the tune of $500 million. And the other knee-jerk reactions that took place, these numbers are critically important to proper planning and closing out this year and planning, quite frankly, for the next year that we're about to go through.
Do you have an estimate of what is your estimate of total of the statutory obligations if added to the current budget? What would our total budget be?
The last time that we looked at that, which was back in the summer, we projected for fiscal year 12, because that was really the question, a structural deficit of about $10.5 billion. That structural deficit being the difference between the revenue from existing revenue sources compared to our statutory obligations, and where there wasn't a statutory provision, a continuation of current activities. So for instance, for higher education, we don't have a formula in the law that says how much they get. So keeping them where they were.
So whether it's 11 billion, 10 billion, 10.5 billion, and what's a half a billion between friends, how would the state of New Jersey generate the differential between the current revenue and the revenue required to meet those obligations? How would we do that?
I mean, that would be extraordinarily difficult. I mean, if it's 10.5 billion, for instance, then that would mean if you were going to raise, you're simply going to raise revenue to close that gap, you'd, in rough numbers, need to double income tax rates or double the sales tax rate, or some combination of those or some other things. But that's the order of matters.
We don't know where they are on their Medicaid fraud position. We don't have answers to where they are on the litigation with the escheat legislation that we talked about. So the question is whether or not you may have that money to invest in other worthwhile programs. We just don't know. And we have argued for years, and we have enhanced the